The information flow is endless, and with so many sensational headlines, changing policies, and market fluctuations, it can be tough to keep up with what's most relevant to you as a real estate investor. In Boardroom Brief, we endeavor to discuss and provide our point of view and insights on relevant topics that matter to Greybrook, our investors, and the broader real estate community. Our goal is to provide you with expert opinions in 20 minutes or less.
Sasha, welcome back to another episode of Boardroom Brief. It is 2025. What a start to the year. I'm not talking about Luka Doncic getting traded to the Lakers. I am talking about that scary T word.
Yeah.
Tariffs.
I don't know which was more unbelievable as to what's happening, to be honest.
I know it's been a wild start, but yeah. I think, listen, everyone from all walks of life are talking about tariffs. We're kind of in this hiatus of a trade war right now. You know, we just thought we're about to get tariffs imposed on us. Just a day ago, it's been paused. Tariffs impact every industry, every sector. We're in the real estate business. Can you shed some light on how, if any, impact tariffs could have on both existing real estate that I may already own and the future of investment in real estate as an institution?
Yeah, so just kind of I want to take it back one step. I think everybody's talking about tariffs. It's a huge thing. Like nobody wants a trade war with our largest trading partner and ally. I think that we'll try to avoid that at all costs. I'm hopeful. In a sense, yesterday, we were able to reach an agreement to at least stay the consequences of tariffs for another 30 days. But it leaves us room, I think, to negotiate what is probably likely to be something that hopefully is sustainable to keep that at bay. But we have to prepare ourselves for every outcome. I think, if anything, 2025, the way it started, and even the last few years, if it's taught us anything as investors, is that you have to, prepare for the worst and hope for the best. And that's just the state of the union these days. And I think when it comes to tariffs, it's a very similar thing. So let me kind of break it down into a couple of different levels. First of all, the residential market here north of the border, as well as south of the border, but here predominantly, consumers are an enormous part of this. Buyers, the people who buy real estate, the people who buy homes and condominiums. Of course, any situation where there would be a tariff war that would put strain on our economy would potentially put us into recessionary territory. Yeah. I think would have negative implications on the real estate market because it will keep that consumer subdued. So anytime that there's actual economic consequence, for sure, but also the uncertainty of economic consequence is also real. And I think as long as there's this cloud over our heads until this gets resolved, I expect there to be enough uncertainty out there that we're going to see a subdued market as it relates to the consumer.
Okay.
The second biggest implication for us in the real estate industry, and I'm going to cover three. So that was the first. I think the second is obviously our monetary policy. I think that if there's no tariff war, which again I'm hopeful for, we end up on a trajectory that we've well established that interest rates are going to continue trending downward to the neutral rate that we've been targeting. And I think there's a general consensus that we can do that without damaging the economy any further. In scenario B, where there is a tariff war, I think that the Bank of Canada is going to have to be much more aggressive with how they treat monetary policy, and you're going to see both a lower terminal rate and you're going to see a quicker descent to that terminal rate because they're trying to offset the negative economic impacts through monetary policy stimulus, right?
Sure.
By reducing the cost of credit. And then there'll be other government transfers that are going to, be intended to kind of mitigate the issues. I think that might have long-term consequences, but in the short term, I think that's what we can expect. I don't know that it's going to move the needle all that much on the real estate market because I do think that the uncertainty is still going to weigh heavily on the consumer, and that's the most important thing. It's going to be helpful for people like us that are, have projects under construction, that have mortgage costs and construction loans and things like that. Like, it's going to reduce the cost of that carry. That's a positive. As it relates to the third area, that being the cost of inputs, it's still TBD. And I think, unfortunately, it's very complicated. Like, so when somebody says, well, that's okay, we have steel factories here, we'll just manufacture our own steel. It's not about whether we can manufacture steel. It's about the supply chains that have been established that are very difficult to reconfigure in a short period of time, right? So you might be fabricating steel here, but you might be getting iron ore from Virginia. You might be getting, there could be transport from Mexico or Canada or America. So the inputs in the supply chain are all impacted, and I don't think it's as simple as just close your borders and start doing things for yourselves, right? So the impact to our industry on materials and things like that, it's still too early to tell what that impact would be. So I would say overall, none of this is good for the real estate market, either here or south of the border. But I'm optimistic in a sense, and what I mean when I say that is that this is kind of bringing to a head and highlighting some things that here in Canada we should really be very mindful of, like our own kind of supply chains, our own propensities to consume, things like that, where we're now waking up to the possibility that, hey, you know what, things could change, and now we have to think about Canada and our interprovincial relationships, and how can we fortify our economy vis-a-vis our own means. And I think that will have positive, regardless of what happens, I think it'll have positive impacts on Canada going forward. So as the real estate market is today, for somebody who owns real estate, all of the uncertainty, I think, has an impact, and it's gonna keep a cloud over top of activity. It's gonna keep a cloud over top of values, and we just have to kind of muscle our way through it and batten down the hatches and sort of wait it out. As that uncertainty clears, I am optimistic, like I said, that the changes that we've set in motion, while in the short term they may not have immediate impacts, I think we'll set ourselves up for a future that's a lot more sustainable, and that in turn will also have a positive impact on the real estate market. So as it relates to acquisitions, right? So in a way, everything we own, you got to kind of deal with the conditions that are out there today, and you got to be able to deal with those. But it doesn't dampen our enthusiasm for the future. It actually enhances the enthusiasm in a lot of ways, because we do see, notwithstanding the uncertainty, a way out of this in a much more sustainable, constructive way for the economy and for the country and for immigration and all of these things. So in some ways, all of the negative that we feel is really just gonna come to a head and force us to confront some real issues, just like immigration did, right? Like last year, that maybe it's a 2024 story, but we got to the point where it was too much, too fast, and we had to take a sober second thought and step back and say, you know what, we need to reform this. We need to pace this differently to be more sustainable. So in a lot of ways, I see the same thing happening, and I see it as being more constructive than destructive.
Yeah, I mean, you touch on a really important point, and I think this is another kind of headline that's been ruminating a lot, is that we clearly have a dependency on the U.S. as our major trade partner. A lot of sort of our core sectors are really dependent on, and now because of all of this tariff talk, it's forcing us to shed a light on, well, why is that the case, and why have we established our economy in such a way? The Conservatives brought forward the idea, and you just touched on it, about becoming more domestically dependent. You have interprovincial trade barriers that need to be removed. Do you think there's other policies that the government should enact, or even something like the trade barriers within internal province? And you touched on supply chain and sort of maybe forcing us to create new supply chains that make it easier. But are there other things that, if we actually had a government right now, that we can do to to make ourselves more domestically dependent, especially within the real estate sector, where no one's lost sight of the fact that we still have a housing crisis. That's not going away, right? So clearly we need more housing. What can we do domestically to sort of enable ourselves to put people in homes?
Yeah. So without going into specifics on policy matters, because I got to give that some thought, I think at a broad level, we've got big government at all levels.
Yeah.
And I don't just mean headcount. I mean government's involvement in several different areas of the economy. And that is true at the federal level, the provincial level, and the municipal level. And in housing, we see it most at the municipal level. But that bloated bureaucracy, I think, is our biggest impediment to productivity and growth. Because there's regulation, and then there's too much regulation and over-regulation. And I think we've kind of, over the years, found our way into over-regulation. And if the premiers of the provinces and or the new incoming administration, whoever that is, focuses on maybe not as far as America goes in terms of like getting government out of, cutting all kinds of regulation, I think we got to find a happy medium. But if we can deregulate to a degree and create less bureaucracy and red tape, I think it'll be an immense boost to both broader economic productivity, but the housing market too. Because if you think about one of the biggest barriers to our market for the last 20, 30 years has been supply side insufficiency. Right? We haven't created enough. And it's not for lack of land. And it's somewhat attributable to the lack of infrastructure, but it's largely attributable to the red tape and regulation as it relates to getting approvals, getting permitting in place, being able to move projects forward. And again, I'm going to take the positive out of this, but as it relates to what I'm seeing going forward, we've already seen it where at the municipal level, when it comes to housing, that message of scarcity and regulation being one of the main drivers has really resonated. Now, unfortunately, the market is such where you could deregulate and give us all the approvals we want until there's consumers that can buy on the other end. That's going to be of limiting benefit. But you're already seeing less and less red tape, people trying to kind of get to outcomes rather than just being mired in process. I think if that continues, which I expect it will, along with an improving housing market, lower interest rates, all these things, I think that that's a great formula, and I think we're going to see a lot of growth coming out of this. And what I'm most optimistic about going forward, frankly, if we've talked about this before, but the last 5 years were not comfortable, even at their peaks.
Sure.
Right? People look at our industry and they think, man, you must have loved it in 2021. The answer is no. What we look for is we have such great fundamentals that we're looking for sustainability in the market, right? And when things become euphoric, not good. When things become as barren as they are today, not good. You want conditions that just are the proper cadence of supply demand, and we have that here. It's just a question of working through these kinks, and I think that coming out of the uncertainty that will certainly exist for the better part of this year.
Yeah.
Like I don't think these things resolve themselves in 30 days. I don't think they resolve themselves in 6 months. But I think that the pain that we may feel over the next 12 months is going to set ourselves up for a much better run in the next cycle.
Yeah, and you touched on municipalities, potentially being a little bit bloated and sometimes becoming an impediment to construction. So, I know one of the policies being thrown out as well is incentivizing municipalities when you talk about federal transfers, right? To say, hey, you got to hit quotas, you got to hit targets, you got to put housing out there, or else, we close the coffers on that. I want to shift a little bit to what the sort of institutional money's done in the last little while with respect to some sell-offs that have been happening. So Reuters just put out a report that some of the big hedge funds, some of the big banks, we had the largest sell-off yesterday since August in a lot of the equity stocks. One of the asset classes that they remain in and that they actually are doubling down on happens to be real estate. Obviously as an individual investor, I have a certain lens on real estate and I'm bullish on it for my own reasons. At a very sort of high institutional level where there's really big numbers being thrown around, why do you think some like the Goldman Sachs of the world are continuing to bet on real estate, and while they're pulling out of traditional equities, real estate continues to be bullish for them?
Yeah, that's a great question. I think it's to me a very obvious answer. It might not be obvious to people that don't follow markets and things like that, but equity markets are, if not fully valued, overvalued, and that's kind of the consensus out there. So smart money looks at where equities are at and they're saying, I'm going to trim down my position and take profits off the table because I see more downside than upside risk. The exact opposite is happening in the real estate. Like all the pain that we've been feeling over the last 2-3 years has created some, I don't want to say unprecedented, but certainly rare buying conditions. Like you're buying at the bottom of the market. Like the last deal that we've done at Yonge and Eglinton, for example, we bought high-rise land at a price that maybe we last saw in 2008 or 9, right? Like, so when presented with opportunities at a low point in the market, in a trough, this is when the smart money gets involved. So if you're people like us, it's a little bit of a, I don't want to say it's counterintuitive to the outside looking in, but we have a portfolio and we own what we own, and nobody could foresee the conditions that we'd have to deal with. So you have to work through those issues. It doesn't change our view on how bullish we are about buying right now for tomorrow, right? Just like Goldman Sachs and those you reference. America's a great example of this. So we have a portfolio in the U.S., and our biggest issue at the moment is the fact that lending rates, construction loans, mortgage financing for these big multifamily projects are keyed off of something called SOFR, which is effectively, think about the U.S. 10-year Treasury. That's the best indicator. In October, that was trending positive, right? Interest rates were decelerating. You're seeing the yield of the 10-year come down. That's alleviating those borrowing costs, and it's helping real estate values through cap rate compression. And then in the election, and since the election, all the uncertainty around tariffs and deglobalization of trade and the expectation that could have inflationary impact has reversed that. And now all of a sudden yields are creeping back up. So the bond market's been very volatile, and that has impacted values. Again, uncertainty is the worst thing for investors. You almost, no matter what the outcome, you want to know what the outcome is and have visibility. That's how you make decisions. When it's uncertain, you get a lot of volatility. So that's impacted values negatively. So for the things that we have in our portfolio, we have to battle through that. Like now is not the time to be selling assets. Now it's not the time to be, you just have to hold on to them and you have to wait for things to become clearer. That doesn't change the fact though, that as a buyer, you want to capitalize on this type of uncertainty, right? Because there's a seller somewhere that's forced to sell and needs to sell, and you're going to be able to take advantage of that opportunity and buy at a low point in the cycle and ride that up. So that's why I think what you're seeing is capital flows favoring real estate. While if you're just a spectator and you're looking at the news cycle, you might be asking yourself, why is that the case? Like equities are great and everybody's talking about chips and everybody's talking about NVIDIA and nobody wants offices. Yeah, that's true for this moment in time. But low point, high point. And I think that's the dynamic that you're seeing.
And given all of that, and let's assume for a second that we do actually enter a trade war and there are real tariffs imposed on Canada and institutional money continues to come into real estate as a result. Does that in any way shift Greybrook's kind of long-term strategy, or are we just sort of, to your point, doubling down on what we've been doing, given the fact that it's clearly a strong market?
Yeah, I think we double down, and that isn't born out of ignorance and just doing the same thing that you've always done. We've given a lot of thought to what our thesis is and what drives it. And for us, it's about scarcity. It's about population growth. It's about sort of an inability to meet the housing supply, and that giving us the stability. So we don't see those conditions changing. Tariff war or no tariff war, I think that we have to think about our daily in two ways. Whatever happens, we don't choose those conditions. They're handed to us.
Yeah.
So for everything that we own, whatever implications that has, we have to focus on, navigating to the best possible outcomes given what's presented to us, and that's the job. And I think we do a great job of it. When it comes to acquisitions, it's a bit different, right? Because everything's anew. You don't have to buy anything. You don't have to do anything. You can sit there and be very careful. And in fact, over the past year or so, 2 years, we've been very inactive by our historical standards because the markets take time to adjust. Like they don't just overnight, conditions are precedent, and then all of a sudden, boom, everything adjusts, pricing adjusts. It takes a lot of time, right? So you have to be selective. But I think we're now coming into 2025 expecting there to be a lot more opportunity. It doesn't change the fact that we're going to have some pain to deal with in parts of our portfolio, and that's just part of the job. But it does give us a lot of optimism about the opportunity set that we're going to see going forward, and we're already seeing. So I think that the future is bright, notwithstanding we have a lot of work to do between now and some point down the road.
Yeah, it'll be a very fascinating, I think, 90 days, both from the perspective of we'll see what happens with this sort of tariff situation, and also, if all things kind of align the way they're going right now, the federal election is going to be coming up very soon for us as well. So two kind of major potential policy shifts for us as a country. Be an exciting couple quarters. Thank you, Sasha. Really appreciate your time today.
Thanks.